Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company in focus is ACME Solar Holdings. Its IPO is coming on November 6, closes on 8th, price between 279 and 289 rupees per share. It includes a fresh issue of 2,395 crores and OFS of 505 crores. The total size of the IPO is roughly 2,900 crores at the upper end of the price band. And joining me today is Nikhil Dhingra, who is the CEO of the company, and Ankit Verma, who is the EVP Corporate Finance at the company. And gentlemen, thank you very much for joining us. Mr. Dhingra, to start with, 2,395 crores. You have upsized the primary issuance from 2,000 odd crores. What are you going to use this for proceeds for?
Yeah. Thank you, Sajid, to have us on board. So we are going to use the primary proceeds for repaying the debt of our subsidiaries. And of course, as we reduce the debt, it will help us grow and execute the capital expenditure we plan to undertake in next 2 years.
Give us a sense of your balance sheet, Ankit. What is the kind of consolidated borrowings or debt on your books as of now?
So as of June 24, our consolidated debt in the book is roughly 9,200 odd crore, and our net worth is around 1,940 crore as of June 24.
Okay, and is it possible to give us how much of that debt will come down by?
Yeah, so basically the business model that we have is for every project, right, that gets financed, we raise financing, right? It's a continuous process. But now, as we speak about this particular IPO, our primary issuance is 2,395 crore. Out of that, roughly 1,795 will be used for repayment of one or more project subsidiary. So you can see essentially from this portion, 1,795 project loan will come down. But for the balance project that will be commissioning, of course, we'll be raising debt to fund those projects as well.
Give me a sense of the kind of business that you operate today in terms of operations. How big is it, and what is the kind of projects which are work in progress or under construction?
Sure. So, Sajid, we are an independent power producer. We are the pure play renewable IPP, independent power producer, and we are in the business of supplying power long term to government entities. We solely supply power to government entities, and we have been doing it for last 13 years. So we are an integrated player who develops, bids, develops, finances, and operates the power projects, all the renewable power projects. We have been only in the solar space for the last 13 years. And we have focused on this space because the generation in solar is much more predictable than other sources of renewable power. So from last 13 years, we have executed close to 3.7 gigawatt peak of solar projects. Of course, we have divested around 1.8 gigawatt peak of solar projects. So we have around 1.8 gigawatt peak of solar projects with us today. And as we speak, we have energized a 1.2 gigawatt plant in Jaisalmer, which is 1.8 gigawatt peak of capacity. So aggregating that, we have around 3.6 gigawatt peak of energized projects. And they are all selling power to government entities. So for the 1800 megawatt peak we had before this new plant, we had, Solar Energy Corporation of India is our main customer. And in terms of the operations span across 13 states, 12 states of India. We have plants across India wherever, because historically, as you see, the states used to call the bids for their own procurement. And 2015-16, we had Solar Energy Corporation, which came into being. And then the procurement of electricity became centralized. And that really led to a large growth in the sector because the credit rating of the procurer was immediately elevated because SECI is a AAA entity. And starting 2024, government has really elevated the program in terms of 50 gigawatt procurement every year. And these 50 gigawatts will be procured by 4 central government entities, which are called Renewable Energy Implementation Agencies, being SECI, NTPC, NHPC, and SGVN. So going forward, all of our projects are with these 4 entities. So whatever we are constructing beyond 2025, which is more than 2.5 gigawatt, is all with these central entities. And the historically, it was around 50% of our capacity was with state and 50% was with center.
Give me a sense of your divestment program, because you said you have already divested 1.8 gigawatt of projects. my understanding is that it's these projects require upfront capital, and thereafter it's a annuity kind of income which comes in because you've signed up a PPA, and you've divested 1.8 of completed projects. How does it work? Means is that a part of your program that you set up the project, start execution and operations, and then you divest it?
So it is a choice for raising capital. You have multiple choices of raising capital, as you know. You could dilute your shareholding at the holding company level, at the issuer level, and of course you could have a partnership with a pension fund or a private equity fund, and you could dilute there, right? The other choice is you build it through your own internal accruals. The differentiating point for us has been we had strong internal accruals coming from developing and constructing the project. And of course, we had strong accruals coming from our operational projects, which have been producing power better than the forecasted numbers by lenders. So that gave us strong internal accruals to build the plant on our own, and of course, finance working capital for those projects. So what we did was we realized that the selling an operational project fetches you a good internal accrual at good profit, which you can use to develop new projects, which give you higher return. Because as you know, once the project is operational, the risk is minimized. There is only annuity cash flows which are coming, which are very valuable to somebody who is looking for an annuity. Somebody like a pension fund or a infrastructure focused long-term fund. So they typically buy these assets, and of course, as a part of various strategies they have, and give us a good premium for that. So historically, we have done that quite a bit. We have done around 5 transactions for a very large amount, which gave us a lot of equity at a premium, which we could use to develop new projects, as you see. So that we had done so far. And now, of course, we are substituting that with this IPO, right? Because we will now use the IPO proceeds to reduce our debt and to do capex in future. So that will help us to grow and use this capital. Other two sources of capital for us are internal accruals from our construction and internal accruals from our operational projects, which we will continue to use. So that's how we are planning to do. As you see, some of our peers like Adani is also listed, and you have seen various other companies which have renewable also as part of their portfolio, like Tata Power, GSW. So we thought that listing, because now the understanding of renewables is there in the market, in terms of because a lot of manufacturing companies are also there, a lot of NTPC Green is also coming to the market. So we thought now is the time, and the regulatory framework has been very robust since last 6-7 years, and of course the demand for renewables is also becoming very high. So we believe this is the right time to go public, and then we don't need to sell any assets. So we will use IPO proceeds to grow and then do our capex.
You divested around 369 megawatts to private equity in 2024 fiscal. Ankit, come in here. You had a revenue of 309 crores in first quarter and a PAT of 1.38 crores. Is it because of that divestment that the PAT is lower? And when do you see profitability coming in? Because even though you're sitting on healthy EBITDA margins, your depreciation and interest costs are the major chunk that chip away your cash flows.
Yeah, I think let us look at the business model first. So basically, there are two profit pools, right? So the holding company, which is the list co, actually does the EPC for all the project subsidiaries, right? So that is the one profit pool. The second profit pool or the revenue source is a profit from the sale of electricity that the various project companies are doing. So if you look at the consolidated financials, your the only revenue and the EBITDA that comes in the consolidated financials is the revenue from sale of electricity. While in the standalone financials, you will see only the EPC revenue and the EPC profit. In the consolidated financials, your EPC profit gets eliminated, and the gross block gets reduced accordingly to the extent of the EPC margin. So coming to your point, yes, in June we have sold. If you compare this with June 23 financials, partly it has reduced because we have monetized few of the assets. And if you look at just PBT, which is profit before tax, our PBT for June 24, was 50 odd crore at the console level. And if you look at the standalone level, which is the construction profit, it was around 150 odd crore. So total profit pool, if you look at the combined standalone plus console, it was around 200 odd crore. And the tax on the EPC profit was around 50 odd crore. So overall, if you look at it on a consolidated basis, it's a profit of roughly 150 odd crore. Having said that, at the consolidated level, because tax accounts for both tax at the standalone level, at the consolidated level, that's why you will see a lower profit in the console at June 23 for financials.
I get that part of it because EPC has its own profit profile. My point was that, you know, on a consolidated level, because since you're going to be listed now, the street will look at consolidated level as a whole and not as standalone for you. So 1.38 crores is Q1. So when do you see other assets generating enough cash flows so that you see a improvement in the consolidated profit profile?
So Sajid, the important thing here is to look at our assets are producing electricity for 30 years. All our PPAs are for 30 years. The depreciation which you see, right, as part of the profit and loss account, right, there is no need to replace any equipment. There is a very marginal, less than, let's say, 0.5% sort of replacement capex you need to do at the end of 3 years. So when you look at any of these businesses, be it us, Adani, and TPC, it has to be a PAT plus depreciation, which is the cash PAT, which needs to be looked at, because that gives you the real cash flow which is there as part of the sale of electricity. The other thing to add to what Ankit mentioned was we used to do EPC partially from our parent company, ACME Cleantech, which of course has been transferred all of it to the issuer company. So that will again add to the profitability on the EPC side. So in terms of our profitability, the profitability, as you know, improves as you move forward in the asset life cycle, because you pay down debt. Because as you know, if we take 75-25 debt equity when we finance a new project, and the debt is for 20 years, right? Because it coincides with the asset life of 25 years. So the debt is for 20 years, and you pay down the debt over a period of time. So as you pay down the debt, the interest cost falls drastically. And as you move forward in the asset life, the profit and loss increases, the PAT increases a lot. As you can see, the Gujarat plant is our oldest plant, which is operating for 13 years. It has a very healthy PAT of around 17-18% because we have paid down a lot of its debt. So on a sustainable basis, as you move, it is, let's say, even in this this quarter, like Ankit was mentioning, we did a PBT because as you have to rightly see what is the tax we paid on the sale of electricity, right? You can't have PBT of the generating company and tax of the EPC business, because that is not rightly calculating the PAT of the generating electricity. So I think we will be able to explain that the PBT, if you want to see, of course, you should add back depreciation. But even if, let's say, somebody looks at PBT, it's around 50 crore on a turnover of around, I think, 300 odd crores, so around 17% PBT. And if you only take tax for that, it will be, let's say, if you even apply, we have less marginal tax rate, but let's say around 20-25%, you will still reach 40 crores, which is around 13-14% PAT at the this thing. And as we told you, we have operationalized assets recently, so of course they will add to the profit pool because the cost remains same. Because this is holding company cost, they don't increase with the operationalization of the assets. So that will add to the profit pool, like we spoke about. 3600 being something we have built so far, and 1200 megawatt we have recently energized, which is 1800 megawatt peak. So that is how it will move.
Your operational capacity is around 1340, and the other one which is expected to get operationalized would be 1826, right? Over a period of next few months.
So 1320 odd number is the AC capacity, which is basically the power you have contracted in long-term PPA. For delivering this CUF, which is the capacity utilization factor, we have installed close to 1800 megawatt peak, which is basically the amount of modules we have installed for this capacity, which we are selling to government. So in effect, that is the megawatt peak. 1800 is the megawatt peak we have today. And the new plant which we have energized, which we have also mentioned in the RHP, right, is a 1200 megawatt plant, which we have energized. So that is already energized. So that is, in terms of AC, if I speak about 1300 plus 1200 is 2500 megawatt AC. And in terms of DC, it is 1800 megawatt peak plus 1800 megawatt peak more to 3600 megawatt peak DC. And beyond this, Sajid, we have PPAs we have signed, right? And of course, we are constructing them. As you know, in this sector, the execution is very much faster than the thermal sector. You only get around 2 years, 18 months to 24 months to execute the plant. So we have a sizable number of projects which we are constructing, right? Which we have also mentioned, which is close to 3800 megawatt of projects, which we will execute in the next 2 years. So as per the PPA timelines. So that is something which will need some capex, which we will be doing, and that will substantially add to whatever numbers we are doing.
One of the things which is there is the related party which is here, because you purchase your entire equipment from ACME Cleantech, which is a parent, if I'm not wrong. And ACME, that amount accounts for nearly 80% odd of your purchases, and ACME imports the entire 99% from China. So can you give us a sense of when do you move to domestic equipment, and is ACME Cleantech looking to produce them in India?
Yes, yes. No, it's a very important move which has happened, that ALMM has come into being. So you're right that going forward, we need to buy Indian modules. So historically, as we said, ACME Cleantech was the EPC contractor. It used to execute a part of the EPC project. So every EPC business was accounted for in ACME Cleantech, and it used to procure module and the balance of system. There are two parts to building a solar plant. One is equipment, and another is a balance of system. So the balance of system contract was with ACME Solar Holdings, and the modules contract and key equipment was with ACME Cleantech. So that again will move to ACME Solar Holding only, because now earlier it was a 100% subsidiary of ACME Cleantech, so it did not make any difference. But now, since the issuer is we are listing the company, so we have transferred the whole EPC business into ACME Solar Holdings, and also the O&M business also into ACME Solar Holdings. So the import used to happen from China, because all of our projects which we were executing till date, they had that provision that you could import from China, because they were pre-ALMM projects. So in a pre-ALMM, which is approved list of module manufacturer, that is the concept of MNRE, through which you are not allowed to buy non-approved modules. So there was a facility to buy everything from China, and of course it was very cost efficient, and it was something which the whole IPP sector was doing, buying from China, because they are the largest producer in the world. So going forward, we will have to buy from India, and we have started doing that because the new plant which we are building is already in that category where you need to buy from India. So we are, of course, looking at multiple strategies to buy from India. We have multiple producers who we are working with, and there are a lot of quality producers in India now. That sector has really grown. So we have sufficient capacity available for buying modules. As of now, it is the modules which are currently not allowed. Going forward, like the government is talking about approved list of cell manufacturers. So as the sector evolves in India, you will see more and more supply chain shift to India. And of course, other key parts are also there where China is dominant. So you will see some part of the supply chain coming from China, where they are more cost efficient. And as and when the supply chain shifts to India, we will have to shift to India. There is no choice. And of course, India is also growing by leaps and bounds on the manufacturing side. So that will be good for the overall country and for all of us, because it also reduces risk in terms of the dollar risk and various other geopolitical risks which are there when you are buying from a foreign country.
Ankit, give me a sense of your operational cash flows. How will it move from here? Because just to get an understanding, because last year we had the asset which you got divested, so we know what kind of cash flows would have come in. And in Q1, because that was absent, your profitability on a consolidated level has come down. So give us a sense of the kind of cash flows that you see from your existing solar operation, especially sale of electricity.
Yeah. So I'll not be able to comment on the numbers.
Give us a Q1 idea so we can see how it moves to on an annualized basis.
Yeah. So in terms of the plan, the capacity plan, Sajid. So the way we are thinking about this is we have an order book of roughly 3,800 megawatt that we have to execute over a period of 18 to 24 months. Now, how this capacity will come up is that out of this 3,800 megawatt, roughly 450 megawatt is expected to come up by end of this year, by FY25. And balance, whatever capacity, it has a construction timeline of 2 years from the date of signing of the PPA. So that is expected to come by entirely by FY27. So on a portfolio basis, our company, is expected to be roughly a 6.2 gigawatt company, by FY27. But in terms of
I'll just see. We have mentioned about the PBT level profitability, Sajid, right? At the EPC level in June, and also at the sale of electricity level. So you just have to add back depreciation to look at our operational cash flows, and then have to reduce the debt repayment, because initially the debt repayment is very minuscule, because it's a 20-year debt. As you can imagine, the initial 5 years only have a very little debt to repay, because it is all more ballooning kind of a structure. So the cash flows are much healthier, because the PBT itself is around 50 crores from the sale of electricity. So depreciation, as you will note, will be much higher than that. So maybe PAT plus PBT plus depreciation will be very high. And of course, that's a very strong operational cash flow. And you have to add the EPC cash flows to it, to look at the real internal accruals we have to build these assets. So of course, the sale of electricity is our primary business, and that continues for 25 years. As you repay down the debt, the cash flows keep on increasing, because your debt liability has gone down and your cash flows are going up. So on a PBT level, as you can see, 50 crore on a 300 crores kind of a number is there. And then depreciation is something which is for 30 years on a book level and 14 years on a tax level. So that really moves your tax and depreciation. So that's how your operational cash flow is. On a PAT basis, you have to look at both the financials sheet to calculate the operational cash flow. It's slightly, it has to be looked at in entirety, because any power company will have to do multiple SPVs. And the good thing with us is that we are doing everything in the same company, the EPC, O&M. So you will have strong cash flows coming from both of these. And also control of time and process, and the whole development pipeline, which includes bidding the plant, buying land for it, having connectivity for the current projects and the future projects. So that gives you the overall picture on the numbers and the
Ankit,
process.
can you also talk about the receivable days, 112 days? That seems a little high. And which are the states where you have the higher receivables coming from? My understanding is Telangana and AP together account for nearly 31-32%.
Yeah, that's right. As of June 24, we have receivable days of 112 days. So it's a combination of, if you look at the current portfolio, so roughly out of this 1340 megawatt, roughly 840 megawatt is from the state discoms, and balance 500 megawatts is from SECI and NTPC. So out of this, majority that you rightly said is from the AP and Telangana assets, which accounts for roughly 30%, as you rightly said. But from the central discoms, receivable days is less than 60 days.
So in AP,
over a period of 3 years, if you look at the receivable cycle, it has come down from originally 228 days in FY22 to 112 days as we speak today.
So Sajid, if you remove so AP, just on that, they had basically been paying their old dues in an EMI format. Some of their dues are in the EMI format, which is increasing the receivables to 112 days. If you remove that, the receivable days falls down to a very low number, because the SECI and NTPC and all other receivables are coming within the due period of around 60 days. 60 days is the due period where they need to pay us. Otherwise, the late payment surcharge comes into being. What has happened in the sector is the late payment surcharge scheme, which came into being in 2022, that really helped everybody, not us, but including thermal players and a lot of other players, resolve their receivables which were pending. Of course, the renewable only issue was with AP starting from 2019, which got solved by the Supreme Court ruling also. But the late payment surcharge really helped. There is no current due from AP. There were old dues which are in the EMI format, which is leading to 112. As you can see, it has been coming down because they have also been paying their old dues also. On the current dues basis, they are also not at any delay of 60 days. So the receivable days, we actually pay a lot of cash discount, whoever pays within the 30 days or 45 days as prescribed in the PPA. So a lot of our counterparties are paying before the scheduled date of 60 days also.
And just to add, all the projects that we have won, which are under construction, are with all central utilities now, with SECI, NTPC, NHPC, and SGPN.
You've set out, aggressive target of battery storage contract, which is 2.3 gigawatt. There's a pump storage of 600 megawatt, which is there in the UP. And then you have a total capex requirement of 38,465 crores as per your RHP. How are you going to fund this?
Sure. So 38,000 crore is our capex plan for the next 2.5 years, right? So that takes around 75% debt and 25% equity. right? So in terms of the debt, we have been, our leading lenders are Power Finance Corporation, REC, IRIDA, SBI. So they have, and already we have sanctioned around 10,000 odd crores of debt already. And of course, the debt sanction happens typically once the PPA is signed. So as and when the PPA is getting signed, the debt is getting sanctioned. The equity piece is close to around 8,000 crores, which is something we have to finance through multiple sources, like we mentioned about the EPC accruals, then the power sale surplus cash flows, because we spoke about 3.7 gigawatt peak of assets. They will produce these surplus cash flows. And the third source is the primary proceeds, through which we are reducing the debt, which will increase our accruals to that extent. So that's the plan. And of course, these capex also needs to happen in phases. The first year you typically do around 25-30%, and then you do rest of the capex, because these are all staggered expenditures. You need to have connectivity in place to basically do these projects on time, which we have. Which we do have, and and we have connectivity for future assets also. So that gives you an advantage in terms of the generation you will do, because typically all the lenders and your investors are looking for your predictable generation and the predictable cash flows you do, because your strength in the business comes from doing the numbers you promised to do, right? So the solar sector, and of course even in our in a hybrid and battery link projects which you spoke about. So battery is a very smaller part of the capex in these FDRE and hybrid projects. Solar continues to be the major source of capex, because typically solar is more predictable, as I was saying at the start, and that's why we continue with having solar as a major part of the portfolio, even in these battery link projects. Battery is much smaller in capex, because battery costs, as you must have seen, have fallen a lot in the last couple of years. And it's a very small component of the overall capex, because and the installations of battery are only for we are not giving 24-hour power, right? Renewable power. We are giving power to the extent of 2 to 4 hours as per our PPA requirement. Okay. So not huge amount of batteries are required, but they need to be integrated well in terms of a solar generation. Some bit of wind we also need to do, right? And some bit of battery installations we need to do. So it requires a very good interplay of designing a perfect solution for the client, solving their problem of having a peak requirement in a particular span of day. So that gives you an edge in terms of designing the right solution and getting a tariff which works for both them and you. And because of that, we have seen a healthier growth. I think more than the tariffs and profitability, I think what it has aided is expand the sector by leaps and bounds in terms of the demand for electricity.
Mr. Dhingra, it was a pleasure talking to you today. Your IPO is opening on November 6, closes on November 8. Price between 279 to 289 rupees per share. It's a 2,900 crore IPO, which has a fresh issue component of 2395 crores, mainly used to pay off the borrowings of subsidiaries. That was the IPO, and at the upper end of the price band, the company is valued at $2 billion. Thank you very much for joining us on IPO today.
Thanks a lot. Thank you.